Canadian inflation unexpectedly rose in the month of April. We're going to dissect that a bit and talk about what we think the Bank of Canada's next move might be. On top of this, our friends over at the RBC have said that spring of 2023 looks to be the turnaround or mark the turnaround point for the Canadian housing market as a whole. On top of that, the Q1 data is officially in for population growth in Canada. And oh my, you're going to want to stick around to hear that. We're going to talk about all this and as well a little bit on the national housing numbers because those are always moving and always interesting. And of course, where we think the month will end up, or will we think that the summertime here is actually going to slow down our marketplace? Well, we'll give you all of our insights and more in this episode. And just so you know, Ryan and I, we've been through a few cycles now, and we help people just like yourselves navigate this fast moving market. So if you're thinking about making a move, give us a call. Our contact information is below, and we'd happily discuss our thoughts with you. Okay. Right off the top, we definitely want to talk about inflation. We'll get the exciting stuff out of the way here right off the top. So it did rise. Okay. So inflation rose 0.1% last month and is now sitting at 4.4%. The thing was, it was expected to drop only 0.2%. And of course, this is coming off the back of a 0.9% drop as well. So the rate of decline of inflation was expected to slow, but it actually rose. And this is the first increase we've seen in inflation dating back to June of 2022. The increase was mostly driven by higher shelter costs. No joke, no kidding as well, right? We're talking about higher rents. As we know, we're still hitting all-time highs, and higher mortgage interest rates and costs, obviously driven by inflation and driven by higher rates. In essence, part of this means that the Bank of Canada is kind of chasing its own tail. And what I mean by that is that the interest costs within the CPI basket, how they measure it, is up about 30% year over year. It is adding a record 0.8% to the total reading. And for reference, back in 2019, when rates were a bit higher, it was increasing it by about 0.22%. And we're up 0.8% today within that basket. It is definitely not easy to beat inflation with a tool that helps cause inflation, right? The higher the interest rates, the higher the mortgage interest payments goes, which adds to the rate of inflation. Have fun with that, Tiff Macklem. Now, last time we talked about interest rates, there were rate cuts expected by the end of this year, as early as Q3, maybe Q4. Those expectations are now completely washed out from the marketplace, and talk about a fast-moving marketplace. It seems like every time we touch on interest rates and inflation, it dramatically changed from just the month before. Tiff, on his last reading, basically kind of did a bit of a victory lap, stating that he felt that inflation was starting to get under control. And then the very next month, it rises. Ouch. A bit of egg on his face there. Now, in the recent press release too, he was also basically quoted as saying, look, don't expect interest rates to come down to anywhere close to where they were before. Whatever that means specifically, we don't know. And this is also coming from the same person who said rates were going to stay low for a long time. So hard to take this man's word anymore. But at the end of the day, the current tone is that don't expect rates to get very low again, if ever. Now, instead of these rates potentially coming down in the next couple quarters, the markets are now pricing in the chance of one rate hike in around 20 to 25 basis points sometime in the next 6 months, likely to happen around October or November. Of course, we know by this time next month, we may have a very different sentiment for you. But as of today, that's what the landscape moving forward looks like. Now, when is the next rate announcement? That is coming next month in June. It's happening on June 7th. The markets are pricing in a 30% chance of a rate hike. I don't think that's going to happen. I think we are going to see rates stay the same for the third announcement in a row. Now, let's quickly remember, it was a few, maybe 2 short months ago, that rates were expected, inflation rates were expected to be sub 3% by the June print. That's only 2 months away here. And now we're in an increasing environment, sitting at 4.4%. We'd have to see a 0.7% or more decline in the next 2 prints. Will that happen? Well, we'll do our best to keep you up to date on that. But fascinating how different the sentiment is on inflation compared to just 1 month ago.
Yeah, no kidding. I think I don't envy, like I said, I don't envy the Bank of Canada or TIF's job. But at the end of the day, As we continue to look at year over year changes in inflation too, it's going to get, those gaps are going to get smaller and smaller and smaller as we have a baseline effect where, this time next year, going from, call it, I don't know, 3.5% down to 3, or 3 down to 2.8 is going to be a big jump. It's going to be hard to do. And that this next sort of 4% down to 2% is going to be the second stage, in my opinion, of the inflation fight. So, kind of speaking to that, let's talk about bond yields, because for the first sort of quarter of the year, they were on their way down. In fact, they took a sharp turn at one point, which I think kind of led to everybody believing that inflation was going to aggressively come down. But with inflation having balanced and now come back up, bond yields are up to 3.3% from 2.87% just 2 weeks ago. And that's a 50 basis point hike. I would expect that to push, fixed rates back up. They were in the low fours, mid to low fours. We'll probably see mid to high fours now. But again, still lower than your variable rate at 5.6%. The yield curve, it's still an inverted yield curve to the tune of 100 basis points. And this is a historic instrument when it looks to foretelling of a recession. And at this point, I don't know if we'll see a recession in 2023, but it's not out of the books that it could take until 2024 for this to actually set in if the Bank of Canada continues to raise rates or continues to take more of a more aggressive stance towards that 2% inflation target.
We're about 15 months in now to the rate hiking cycle, and the full effects truly, I think, have yet to be fully realized, though they are really starting to show up and be demonstrated within businesses and their insolvencies, right? If you want to slow down the economy, you take away businesses' ability to borrow money and fund essentially their operations. So business insolvencies are definitely on the rise, as well as consumer insolvencies, which we touched on quite a bit on last week's episode. So check that out if you missed it. But business insolvencies hit something like 440 last month. This is a national number, of course. And that's the highest read in at least the last 4 years. But what's more so is essentially the dollar volume of the liabilities of these filings are up 800% year over year. So as businesses fail, as people get laid off, you can imagine obviously people are going to pull back on their spending. And if that continues to trigger unemployment to come off of its essentially record lows right now, that will slow things further. If rates stay where they are or increase, this is going to exemplify this issue. And so we're paying quite a bit of attention to it, and we'll keep you up to date on it.
It's interesting because business insolvencies, I think they're really a result of having that massive cash injection through COVID and having very, very low rates to borrow money from. Most businesses needed to do that in order to compete with the people or their competitors who were doing the same thing. The problem that lies in there is that as you want to compete, you want to add a truck, or you want to add labor, or you want to add these things to your business in order to take on more business so you can compete, only to then have your cash taken away from you, or your ability to borrow taken away from you. And now you can no longer pay those wages or compete in the same way. And it's I think a lot of these sort of insolvencies are a result of having to inject our economy with so much cash. And then having to go through such an aggressive rate hike cycle tightening. I just think that this is a result of really that process. And another big result of that has been wage growth, because wage growth is now outpacing the inflation rate. However, this is like in my opinion, and I think sort of the perspective around this, we should at least have a little bit of dialogue about whether or not it's the right argument anymore. I mean, if you go back over the last 20, 30 years, central bankers have been looking for ways to raise the average wage. And it's been very difficult to get wage increases that sort of align with the growth of the economy or simply the growth of assets. And so, we're being told now that inflation is going to get sticky because wages have gone up. And so now we have to, that permeates and stays in our economy. And now we consistently have to pay more for things, including labor. But, wage growth isn't always a bad thing, because it certainly can help improve the cost of living. And I think, we're not paying enough attention to some of the more volatile parts of our economy. Like when we take out the things out of the CPI basket, why are we doing that? It's because we don't want to have a discussion around things like fuel consumption, energy prices, global shipping, transport costs. We have a very integrated global supply chain. And, these integrated forces are powerful. And it kind of begs the question, is the average consumer, you and me and everybody listening in this podcast, going to pay the price through higher interest rates for the larger global forces that are at play here? And I guess what I'm asking is are we still attacking the right problem? Because going forward, I think the future drivers of inflation are going to be a little bit different than the ones we've seen in the past. We have a globalized economy, and for the last 100 years, we've seen how integrated that's become. And if we look back maybe over the last 4 to 8 years, it's gone backwards in a way towards a more nationalist position. Think about Make America Great Again, One China policy, and these insertions of large, trade tariffs and protectionist perspectives. It's extremely disruptive to the globalized economy that we've had over the last 100 years. So, when I look at wage growth and the argument that it's, that's the thing now that the Bank of Canada is really concerned about, shouldn't we really be concerned about some of the more volatile things in our economy that really push prices around? And I think, we might be attacking the wrong thing or looking at the wrong problem. But anyways, that was a bit of a longer diatribe than I had anticipated, but I think it's an important part of the conversation.
I guess if wages are outpacing inflation right now, and maybe that's what's helping feed into consumer confidence, because that's been on the rise for about 3-4 months now. And so if people are starting to feel wealthier again, well, what do? They buy stuff and they buy homes. And that may very well be part of what led to the 11% national jump in home sales month over month here in Canada. That's the largest month over month gain we've seen essentially since the country was locked down during COVID. So that's not a small number. And this is all happening at a time when we're in the 5th month in a row of 20-year lows in new listings. And of course, what does that do to the sales to new listings ratio? Well, it's ripped up now to about 70%, which is well into a seller's market. And if you can believe it, it's higher today than it was during the 2016-2017 national housing appreciation race, if you will, and is the highest since 2021. We're not higher than we were then, but that was a different world that we will likely never see again. We were literally in a buyer's market to start off this year, and we flew through balance and we're well into sellers now. That's how quick things have changed here. And again, in an environment where the interest rates, the same interest rates that brought the housing prices down, are still here today, and yet housing prices are going back up. This is largely due to the good old story, inventory. It is a national issue. It's actually happening in other countries too. America is definitely experiencing low inventory volume. So is Australia, and I'm sure it is exemplified even further. But looking nationally here, inventory just saw last month its second steepest decline on record, going back as far as the data does. Inventory nationally dropped 6% just last month. And if you're ready for this, Ontario saw its provincial inventory drop 10% in 1 month and is now down 24% over 4 months. Whoa. A quarter of the already low inventory disappeared in 4 months. It's unbelievable. So nationally here, inventory was climbing, and it got to about 140,000 active listings across the country. That's now dropped to about 125,000. And keep in mind, for reference, it was a short 8 years ago where we were over 250,000. It was double the inventory just 8 years ago.
Wow. I wish I had a little bit more acumen to explain how that's happened. My goodness. It kind of goes and into our next point, which is that RBC has released a report on Monday of this week by the assistant chief economist, Robert, I'm going to mispronounce his last name here, but Hogue said that spring 2023 increasingly looks like the turnaround point for Canada's housing market after a year-long slump. And Hogue said that home resales, this is nationally, of course, spurted 11.3% month over month nationwide, making it the strongest monthly advance in almost 3 years. He said prices also rose in back-to-back months for the first time since early 2022. And this is adding that a vast majority of local markets were also contributing to this. He mentioned that demand and supply conditions suddenly appear tight, although, we've been reporting for the last, Dan, I don't know, 5 months that inventory has been remarkably low and will continue to be the issue. With that, he said, resurging demand and low inventories have put sellers back in the driver's seat in most major markets. That includes Toronto, Vancouver, Calgary, and Halifax. So we're starting to really see the market across the nation begin to get some heat back into it here. And then I want to talk a little bit about population as well, because
wait, sorry. I definitely have to comment on this because I find it a little bit odd. While he's correct,
yeah,
this was released May 14th or something like that.
Yeah,
you'd think RBC would have access to data that maybe even we do. And what I mean by that is that, yeah, he's stating the obvious at this point. But again, the market turned not in spring, the market turned in January. Mm-hmm. And all the data exists there, right? It's very easy to look backwards in time, pull the data and say that, things really started to actually change here in January. And it looks like they're only referencing maybe like the HPI too. So a little bit funny that I find that they're calling it now after it's already kind of happened. But again, if anything, this is just going to kind of contribute further to a bit of the FOMO because people are going to pay attention to things like RBC more than they will us. But at the end of the day, it's a lagging report, in my opinion, by about 4 or 5 months.
Yeah, I don't disagree. I also wonder, Dan, do you know if any other banks have come out and released anything like this? As far as I'm concerned, RBC, I think, is the first one to say, hey, the market has quote unquote bottomed out and we're on the rise again. I don't know if another one has. So it's interesting because it's 4 months late and yet no other bank wants to step up.
I think TD does, but I don't have the reference here, so don't quote me on it.
Fair enough. And maybe, they're also taking into account the population data because that's part of this argument too, right? So Q1 data is in. And we are setting some insane records here. And I mean by records by like big margins. PR admissions here hit 145,000, beating the 2022 record of 110,000. Non-PR admissions hit 350,000, beating 2021's 210. At this pace, by the end of 2023, permanent residents will total roughly 580,000, plus non-permanent resident estimate of 1.4 million puts us at a combined population growth of just under 2 million people. When you consider just the natural population growth that our country is going to go through as well, we are on track to exceed 2 million new people in Canada by the end of 2023. I don't know if we've ever done anything near that, Dan, historically, like nowhere close.
Yeah, the post-war numbers were big. I don't believe they were this big. This is unbelievable. And again, this is coming off of an almost record-setting 2022, where we already recognized that to be causing a huge strain on the housing market, both rental, of course, which is currently at all-time highs, and obviously resale and pre-sale homes, which again are almost back to all-time high prices again, even with this current interest rate environment. And so that means we need homes, right? We need to build homes for all these people because, again, we know the government said, yeah, great, throw 2 million people into the country at the federal level, and the municipal level are being like, well, we're not going to build enough houses and we're not going to rezone. And yes, things are starting to change there. We know what happened in Toronto, where they rezoned all single family lots to be multifamily. It may happen later this year in British Columbia as well. But what's happening with actual homes? Well, let's first look to the single family home, which, as we've said a few times on our channel here, that it's basically going the way of the dinosaur. And check this out. Building permits for single family homes nationally are down 40% since just last year, early 2022. Multifamily on the other side, when we're talking about housing starts, they're down as well, sitting at about 140,000, down from 155,000, looking at a 6-month trend. That's for sort of what's coming now. And again, of course, people that are in the development trade pull back when things are slow and costs are high and labor is high. the market's turning again, but construction lags that. Okay. But let's look at our under construction homes, because typically once you start building, you're not going to stop. Right now, today, nationally under construction, there's about 160,000 condos. There's about 125,000 purpose built rental units coming, and about 60,000 single family homes. So while there's decent under construction happening, once those builds are complete, what's right behind that is less homes are being built. So it's going to continue to trend up. Right now, developers are getting more excited because, of course, there's money in the marketplace, meaning that people are willing to spend money on new homes. But hey, we'll see if that changes as well, should rates increase again later this year.
Not only willing, but I think they also have to. I mean, there just might not be any other option at this point. When you consider the fact that, you know, rents are at all-time highs, it doesn't surprise me that people are back to buying again. There's At least you own something when you buy it, and you can pay it down and you can gain some equity. Just, it makes more sense in my mind, and kind of logically explains some of this. With that being said, though, let's take a quick look at new mortgages as well, because the origination volumes are down since the middle of 2021. This is not all that surprising, because it started to happen as basically since the rate hikes started. They peaked at about 50% in 2020. And now they are sitting minus 40%. And this is based on a 3-month average change year over year. So, again, I think that's a result of, it could be somewhat of a lagging indicator, especially, in the last half of this year. But as it continues to change and move forward, I think we'll start to see some of that pick up, especially depending on what the Bank of Canada does here.
Yeah, it definitely will. And we can definitely be a testament to that based on what's happening in GVRD in the month of May. Quick insight of what to expect, of what's coming here. May will be the first sales volumes in 1 year where we're going to see an increase year over year. We've been down, down, down. And of course, now we happen to be ticking upwards, which of course will see those mortgage originations start to tick up as well, as we're seeing higher sales volumes. And these higher sales volumes are happening on higher prices. Median right now in the month is up like 20K. We're sitting at about 970,000. Average prices up 25,000 so far this month, sitting at about 1.322 million. Inventory is still the story, right? We've been sub 9,000 since December. Right now we're sitting at 9,200, but hey, it could all wash out as some properties get delisted on the final day of the month. So again, this might be the 5th or 6th month in a row, sub 9,000. We've seen inventory flatline since the beginning of this year, which again has never happened in recorded history. We've seen low inventory, but we've never seen it flatline sub 9,000 before. So Ryan, what's coming next? What is summer going to look like? Because I think that's a huge question. We're a month and a half here off of summer for Vancouver. Typically, sales slow down dramatically then. But things have been far from typical, especially through COVID, right? We saw 2020, 2021, and part of 2022. We saw those summers remain highly elevated for sales. What's your predicament for this year?
My prediction for this year, I still don't think we're going to lose. Let me rephrase that. I still think we're going to have lower sales volumes. I think, especially month over month, I don't see us having, lifted sales volumes. The thing is, and the reason I know that is because or at least I think that's the case, is when I look at, trying to book something for, up in the Okanagan or Sunshine Coast for, a weekend away in the summer here, everything's booked. Rates are extremely high. That hasn't changed. And, I've got a number of people, my daughter's in school, talking to a number of families. They're still seeing vacations. They're still going away. So I think things will continue to historically slow down, but I also think there's a lot of people who have been looking for homes now, and a lot of it's been frustrating for them. And so I think you're going to see a higher number of people hanging around in the summertime looking for those deals and looking for property, knowing that it's likely we're going to see a more competitive September and October. And I do think we'll see far more listings in September and October than we will in the summertime. But if you are a diligent buyer and you're committed to your cause, I would not stop during this phase, this is where you're likely going to have a little bit less competition than you would if you waited, say, until September or October.
Well, speaking of competition, Ryan just told us the Q1 population growth numbers for Canada, right? That's fact. That's a number. It's done. That's already happened. That means we're averaging about 5,500 new people into Canada every single day. Okay. If GVRD takes in even 10% of that, that's 550 people into GVRD every single day looking for homes, renting or buying. You can understand how the competition is increasing because we are not building housing for 550 people a day. I guarantee you that.
Yeah, I completely agree with that. I don't, I think our long-term outlook, especially even far beyond summer, I think I think a lot of people were hoping that, higher rates were going to cause people to, put their property on the market. I think we're still probably 2 or 3 years away from that. I think what's going to happen is we'll start to see some more inventory when people have to renew at much higher rates than maybe what they're locked in at now. But we're still 2-3 years away from that. And in that time, Dan, so many people are going to come here and going to need places to live. And somebody may have to refinance, but when they refinance and they can't afford it, when they go to sell it, they are going to take a significant profit. That will happen. And that'll likely happen because of so many people.
And that's also 2.5, 3 years for the banks to come up with ways to keep people in those same homes that, yes, they have to refi at a higher price or higher payment. Of course, that's difficult, but they know that's coming. They're getting ahead of this now. And I will not be surprised if they find a way to help people make those payments somehow. Right? Yet to be seen. But again, do they want to see tens of thousands of properties go on the market because of foreclosure? Of course not. They can't even handle that. So can they, stroke the pen and say, oh, yeah, 50-year AMs for everybody, whatever it is? Of course, that's easier to be seen.
Or Dan, like we talked about in our last program, how the UK is introducing, a zero down payment policy, something to that effect. Or if homes just continue to rise at an unaffordable rate, what is the government also going to do to step in to make it more affordable for first time home buyers? I can tell you that in 3 years from now, our current first time home buyers incentives aren't going to make any sense. They already don't. So,
well, they're not being utilized.
Well, yeah. And our thresholds are just way too low, especially for places like Vancouver, right? So something's got to change. The way it currently is working right now is, in my mind, only going to lead to higher prices and, more unaffordability.
Very true, and very fascinating times as always. So the housing crunch continues. We're going to continue to do what we do and try to inform best we can. So thanks as always for tuning in, and we'll see you next Saturday.